Welcome to today's explainer. Let me ask you a question right out of the gate. Have you ever entered a trade based on a perfectly crossed moving average or a glowing MACD signal, only to immediately watch the market reverse and completely crush your position? If you're constantly feeling like you're just one step behind the market, it's time to seriously question the reliability of your favorite trading indicators. Today, we're stripping away all that noise and looking at the raw truth of the market. We're going to uncover 4 absolute game-changing price action secrets that form the ultimate trading guide, and this is going to transform you from a reactive trader into a proactive one. So, here's our game plan for today. We'll start with the problem with traditional indicators, unpack 4 specific price action secrets, candlestick bodies, mean reversion, momentum, and pullbacks, and then finally, we'll combine the whole shebang into a practical, step-by-step strategy for your daily charts. Alright, part 1, the problem with indicators. We really have to start here by addressing the elephant in the room. Why do so many traders still struggle to turn a consistent profit, even when their charts are absolutely covered in these popular, complex technical tools? Well, the stark contrast really comes down to time. Tools like moving averages, MACD, and RSI are what we call lagging indicators because they require previous price data as an input to calculate their formulas. They're inherently delayed. You're essentially driving while looking in the rearview mirror. Sure, they might give you a signal to buy, but honestly, by the time they do, the chart has often already made its major move. Price action, on the other hand, is right here, right now. It allows you to analyze current movements for immediate, in-the-moment decisions. It actually empowers you to read the market without that built-in delay. And that brings us to our first core concept. Part 2, Secret 1, Candlestick Bodies. You know, when most folks look at a candlestick chart, their eyes get completely distracted by the wicks, those thin little lines shooting out at the top and bottom. But we're going to shift our focus to the solid body itself. Take a look at this specific characteristic. When you spot a large green candle that completely lacks any wicks, you are looking at pure, unadulterated market dominance. This specific formation means that buyers found this price so incredibly attractive that they just started buying in huge, aggressive quantities. The buying pressure was so intense and the selling pressure was so non-existent that sellers couldn't even fight back for a single moment. That's exactly why there are no wicks. It represents total buyer control and is a massively bullish sign. So the crucial point is how we actually use that information. One of the absolute golden rules of trading is that the past predicts the future. That strong wickless green close leaves a permanent footprint on the chart. It tells us undeniably that buyers loved that specific price level. Therefore, you can use the base of that strong candlestick body to mark a highly reliable support level. Think about it. If the price moves sideways and eventually wanders back to that exact level, chances are very high it'll bounce right back off of it. Why? Because we already know that buyers are waiting right there. Okay, zooming out a bit. Part 3, Secret 2, Mean Reversion. Let's expand our view to the broader market trend and understand the overall breathing rhythm of the chart. Mean reversion is a really simple but absolutely vital definition to grasp. It's the principle that extreme price movements will eventually return to their historical average. Think of the price like a giant rubber band attached to a center point. It can stretch really far up and it can stretch really far down, but it literally cannot run away in one direction forever without eventually snapping back to the middle. And this brilliantly illustrates exactly how we track that center point, the number 50. By applying a 50-day moving average to your chart, you create an anchor. You'll start to notice a really clear pattern here. Whenever the price dips drastically away from this 50-day line, it's stretching that rubber band to its absolute limit. Keeping mean reversion in the back of your mind is a superpower, because when you see a massive downward dip away from this average, it signals a prime buying opportunity. The odds are heavily in your favor that the price will revert and pull back up to that 50-day line. Next up, Part 4, Secret 3, Momentum. Let me ask you this. How can you predict if a chart that's slowly creeping upward is about to make a massive, explosive jump? Well, the answer lies in momentum. Momentum is the rate and speed at which the price is moving. It reveals the underlying hidden strength of the buyers or sellers in the market. So if you see a chart making a very slow, gradual upward climb, and then, after a tiny dip, it suddenly makes a sharp, steep upward movement, wow, that chart is gaining serious momentum. It means fresh buyers are flooding into the market, accelerating the speed of the trend. Recognizing that shift from a gradual slope to a steep slope is exactly how you catch those massive upward jumps way before everyone else does. Moving right along to Part 5, Secret 4, Pullbacks. As you look at any chart, you'll notice it literally never moves in a perfectly straight line, right? That's because traders are naturally taking profits along the way. Understanding the depth of these profit-taking dips is kind of like having a crystal ball for the chart's next major direction. We categorize them into two basic types. First, a weak pullback means only a few traders are exiting their positions to take profit. The dip is shallow, which signals that the broader market is holding strong, and a massive upward movement is likely coming next. A strong pullback, however, means heavy, aggressive exiting. The dip is deep, signaling that the momentum is dying, and you should probably brace yourself for sideways movement or even a complete trend reversal. And now for the really fun part. Part 6. Combining and applying. Knowing these secrets is great, but actually applying them is where the real profit is made. Let's move to your daily charts and see how this builds a rock-solid trading strategy. First, open your preferred chart platform. Second, select the Fibonacci retracement tool from your side menu. Now by default, this tool has way too many levels and will totally clutter your screen. So, step 3 is absolutely crucial. Go into the settings and uncheck everything except 0, 0.382, 0.5, 0.618, and 1. This drastically declutters the screen and makes reading price action completely effortless. Finally, step 4. Simply drag the tool from the lowest low of the recent trend to the highest high. Boom, setup is done. Now, when you do this, you want to fix your eyes on one specific number, 0.382. This is your critical threshold. If you're looking for a long trade, meaning, you want the price to go up, you want to see the profit-taking dip stay above this 0.382 line. If the price pulls back but rests perfectly above this level, that is the literal definition of a weak pullback. It's a highly bullish signal telling you it is incredibly safe to enter the trade because that upward momentum is fully intact. But hey, listen up, because you must heed this warning. If the price crashes heavily through that 0.382 floor, it is instantly transformed into a strong pullback. The buyers have lost control, the momentum is dead, and the smart money is getting out. When it dips below 0.382, you need to prepare for sideways chop or a really heavy reversal. Do not buy that dip expecting it to rocket to new highs. So let's tie this all together. Let's summarize how stacking these concepts creates an incredibly powerful, real-time trading strategy that leaves lagging indicators entirely in the dust. To maximize your trading efficiency on your daily charts, you just need to combine these 4 elements. First, hunt for strong, green candlestick bodies with no wicks to find your rock-solid support zones. Second, look for extreme price dips away from the 50-day moving average to capitalize on mean reversion. Third, watch the angle of the chart and enter your trades right when that upward momentum shifts from gradual to sharp. And finally, use your newly modified Fibonacci tool to mathematically verify that you are buying into a weak pullback before you ever risk a single dollar. By combining these 4 distinct price action secrets, you completely bypass the delayed, frustrating signals of traditional indicators and start trading what the market is actually doing in the present moment. So I leave you with this final thought. Are you ready to ditch the lag, clean up your charts, and start reading the market's true rhythm in real time? Open up your daily charts today, apply that 50-day moving average, set up your Fibonacci tool, and see the clarity for yourself. Thank you so much for joining me for this explainer, and happy trading out there.